With each week that passes, we inch a little closer to Reconstitution Day for the Schwab U.S. Dividend Equity ETF, or SCHD. What's Reconstitution Day? Well, today I'm going to tell you. I'll share what the process looks like each year, the overall SCHD strategy, and how last year's newest additions to the ETF have performed for all of its shareholders. But to get to all the good stuff, we first need to define what reconstitution actually is. Simply stated, reconstitution is like a financial tune-up for the ETF. So if you were to review all of your holdings and compare them to a specific set of standards, you'd remove the underperformers and add new ones to make sure that your money and investments were working effectively to meet your financial goals. And that's essentially what happens every year on the third Friday of March for the Schwab U.S. Dividend Equity ETF. And because so many of us invest in this dividend ETF, I thought it might be helpful for us all to understand the process of reconstitution and how it may affect our overall holdings of SCHD come Monday, March 18th. It all begins with the Dow Jones U.S. Broad Market Index, which is 2,500 of the largest U.S. stocks. But do you know what's not included? Real estate investment trusts or master limited partnerships. So you won't find either of those types of investments in SCHD. They're just not invited to the party. So let's see how you do get an invite. It starts with those 2,500 companies. They're all screened for three different things: a minimum of 10 years of dividend payments, a minimum float-adjusted market cap of $500 million US, and a minimum 3-month average daily trading volume of $2 million. So what does that mean? Well, in simpler terms, the ETF's main goal is to give investors a mix of stable and financially sound companies. So these companies have a history of regularly paying dividends, giving us that minimum of 10 years, a certain size in the market, or that minimum market capitalization, and their stocks are traded actively, meaning they have sufficient liquidity. So that 3-month average trading volume of at least $2 million. The goal is to strike a balance between a source of income through dividends and the potential for long-term growth in the value of the investment. If the companies pass those first 3 screens, they're then ranked in descending order, or from highest to lowest, based on their annual dividend yield. The top half are eligible for stock selection, so the highest yielders. The remaining eligible companies are then ranked based on their cash flow to debt, return on equity, dividend yield, and the 5-year dividend growth rate. The 100 top-ranked stocks by score are then selected to be a part of the index. So I don't know about you all, but the process makes a lot of sense to me as an investor. Finding companies with a strong free cash flow, dividend growth, and a history of paying dividends to shareholders, along with return on equity, it's why I own 350 shares of SCHD and buy at least 1 share every Monday as part of my investing strategy this year. Which, if you missed, I'll share for you down in the comments. This ETF has a total expense ratio of 0.06% and currently has 104 different holdings. But there's a few more things that I'd like for you to know about the reconstitution process. Within SCHD, no single stock can represent more than 4% of the index. And no single sector can represent more than 25% of the index, as measured at the time of index construction, reconstitution, which is where we are now, and any rebalancing. So because the ETF is about to enter the reconstitution phase again, we can expect that on Monday, March 18th, those positions that currently make up more than 4% of the index will be rebalanced. And right now, it looks like the top 5 holdings might be a part of the rebalance. If we look at Broadcom, they're at 5.08%, AbbVie is at 4.68%, Merck & Company, 4.62%, the Home Depot is at 4.35%, and Amgen is at 4.07%. So we'll see how things shake out in the next couple of weeks to see what's going to happen with those numbers. But this happens every year, and I was kind of curious to see how last year's additions to SCHD have actually performed since the reconstitution. Now, I realize that the reconstitution takes place in March every year, but for ease of review, I figured I would just grab the 2023 data and see how the SCHD newbies actually performed. So let's look at a few things. We'll look at the dividend yield, the 5-year dividend growth rate, and we'll take a peek at that total return compared to the S&P 500, which in 2023 put up a 21.6% total return. This will allow us to look at the whole picture, so any share price appreciation or depreciation, along with those dividends being reinvested. And if you've seen my videos before, you know by now that I like some data in a spreadsheet. I'm a bit nerdy, I know. Anyway, I want to look at the companies that were added to SCHD in the last year, and there were actually 25 of them. And of the 25 new additions, 2 holdings are actually in the top 10 of SCHD, which include both AbbVie and Chevron. Now, if we look at the fact sheet from SCHD, you can see that the total returns in 2023, not super impressive comparatively. But let's take a peek at the newest 25 additions in 2023 to see how they all panned out. And of last year's SCHD additions, 11 of them put up a negative total return, including UPS, Chevron, which is in the top 10, Ford Motor Company, which we were all shocked even made it to SCHD, Robert Half International, Advanced Auto Parts, Huntsman Corporation, Wendy's, Cracker Barrel, Clearway Energy Incorporated Class A, Hanmi Financial, Ennis Incorporated, and Central Pacific Financial Corporation. In the last year, the S&P 500 put up a total return of 19.74%, with SCHD at a 1.64% total return. And because SCHD does not allow for one sector to make up more than 25% of the fund, it bears looking at. And as it stands today, the largest sector represented is industrials at 16.83%, followed by financials at 16.56%, and healthcare at 16.24%. So it doesn't look like anything's going to change much in terms of the diversification of the overall holdings. So what do you think this year's Reconstitution is going to bring for us all? Any thoughts on which companies might be eliminated from the lineup and what might be added? Let me know your thoughts below, and then go and take a peek at this video next. I need a sip of something, you guys. I'm sipping a nice tea. What are you guys drinking?